Okay. We are in business now. Okay. So to minimize your. So what I'm going to talk to you is what I do, and most likely most of you guys will be doing the same thing, at least initially. So this is the, if you guys want to leave the talk in the middle, you have something else to do, just concentrate on this page. So anytime you start working, you'll get a gross salary. Then you lose federal tax based on what level you are. You lose state tax. If you live in New York or some other big metropolitan places, you lose city tax. Then it will subtract social security tax, it will subtract Medicare tax, and there will be, of course, your retirement, which is 401k deduction. After all this subtraction, whatever is left is the money in hand. So please don't get very happy that you are going to get paid 150 or 200 or $300,000. After all these things, the thing which falls into your saving or checking account becomes pretty less. Now, the aim to have a successful retirement financially is to save, at least save and invest. Okay, because now we are not going to talk about saving and putting it in the saving account like in India and then hopefully something happens. No. So you will at least invest 10% of the gross, or if not, at least save 10% of the money in hand every month. And the other thing is invest every paycheck. You might get paycheck on the first or on the 15th or once a month. Invest every time you get a paycheck. Invest whether market is up or down. Don't get excited. Well, market is too up. I'll wait when it goes down. Something happens and then you miss the opportunity. So this is called dollar cost averaging, where you invest same amount every same frequency, and over time, after 30 years, suddenly you are a multi-millionaire. And timing, this is the most important. Timing the market is very hard. Many people say they can do it. Those are the guys who try to. Some people are gifted, like they have hedge fund and stuff like that. But ordinary people like us, it's very difficult. You wait, like right now the market is down, and everybody is waiting. Like when it starts going up, I will invest. I have X amount of money. But that day, you went out of the house, and the market suddenly went up 25%, and you lost the opportunity. So time is to small amount saved every paycheck. That's what I did for last 18 years, the first and the 15th. So now these are the different things we'll cover. And I will go fast to stuff which I don't think is very important at this time. Okay, here. So having a plan is very important. Plan is very important. Say, I'm going to retire at the age of 55 or at the age of 60, at the age of 65. And I'm going to talk about people like me who are middle class and upper middle class. So we are the people who are going to work till about 55 or 60 or 65. I'm not talking about person who starts a company at age of 27 and sells it at age of 33 and is retired in the Caribbean at age of 34. No, this is not for that. And I know people who did that. So this is not just a fantastic talk. Okay. Next thing is the key component is asset allocation. What does that mean? Means you put money in shares, in bonds, in multiple different things which are non-correlated. Means right now stock market is going into the drain. But if your investment is there in the real estate, if it is investment is there in small loans to businesses and stuff like that, nothing has happened to you. Your money is safe. So things which don't correlate, like usually stocks and bonds don't correlate, they go opposite to each other. Right now, however, everything is down. But people who have put money in REIT or who have apartment complexes, who or some other things, like I'll tell you other things later when you go to that money is safe. So diversify. not just in different fields, like not just in oil versus um, high tech stuff versus construction, but diversify in modes of different investments. And this is most investors best served if you invest in index fund. So instead of investing in individual shares, um, get into an index fund, and we'll say what index fund is. And you don't have to do too much thinking. Market goes up, you go up. Market goes down, you goes down. An index fund will have 500 different companies. So tomorrow something happens, and Elon Musk just decides to jump off a tall building, and somebody has invested lots of money in Tesla. It's going to go down. But in an index fund, you'll have hundreds of other companies. So one company goes bankrupt, no problem. Others will take over. Other thing is fees make it very hard for active funds to beat passive funds. These are fees. Whenever you invest, you have to look into the fees because you are going to invest for 30 years, 25, 20, 30, 35 years. Over time, these fees keep on adding and it makes a difference. And I have an equation to show you later. And start early. You say, I'm too poor, I barely make my things work. So you are always going to be poor compared to somebody else. I have friends who are very, very affluent. So compared to them, I am poor. But if my needs are defined, remember, you will never be able to satisfy your wants. But as long as your needs are satisfied, you are rich. And the needs you decide yourself. Don't look at your neighbor. Well, if they're good looking, you can, but otherwise don't. So two types of investment accounts, taxable and tax deferred. Taxable are simple. These are the typical account you go open in a brokerage firm and you pay normal taxes every year when you buy and sell something. Basically, when you sell and you made X amount of money, stock appreciated, and you sold them, you made I don't know $50,000, $5,000, and then you pay tax on that. And then there is tax deferred. This is very interesting for retirement. Here, it's also two types. So money either can be put in these accounts either before tax or after tax. So if tomorrow I know uh, VP joins Johnson and John. I don't know why he's joining John, but anyway, somebody joins a company, and they say, okay, we'll start with a starting salary of $85,000. Wow, yeah, good. And then they say, okay, we'll also give you money for this, money for that, and we'll let you put money in retirement account. Now, this money you put in retirement account is pre-tax. This is that money does not show uh, on your income tax you file because this is not going to be the money which shows up in your checking account on the day of your salary. So if you put money as a pre-tax money, like say $100, just making up something, so you have not paid 20% tax on that. So this $100 is actually equivalent to $80 if you had put post-tax. So this $100 are going to increase. You're going to make money on the $100, not $80. So putting pre-tax money is the best, but the government knows this. So government will always limit how much you can put it in. So the earnings grow tax deferred until you withdraw. And once you withdraw, say you become 62, you are retiring, and you start withdrawing money every month to live on, that time you'll be taxed. But remember, that time you are an old person and you are not getting your monthly salary from the company where you worked with. So you're poor. So you'll be taxed at a lower bracket. I don't know, one of, say, I'm just making like say, Pallavji was making $300,000 per year. And after retirement, he's making zero from his salary. So initially he was on the 40 to 43% income tax bracket. Now he's on no bracket. So now the money he's coming out will be taxed at 20% or something. So this is an advantage because all these years you grew that money without tax. and now you're taking out essentially without having to pay the tax which you would have paid when you were working. And of course, there are age restrictions and stuff which you'll know. Now, this is what I talked about. For-profit companies, you work for construction companies, you work for computer companies, you work for any company, there is something called 401k. Now, these numbers, 401, 403, these numbers were not randomly decided. Those were the number subsection of a particular law which was passed. And suddenly we have this number. So 401k, see, for 2020, you can take $19,500 per year and put it in this plan. So you can't usually say, if it's tax deferred, let me put everything I have into this. No. So every year you can only put this much money. Then if you're old, you can add this much plus this much and put it in. Now, if you are valuable and the employer is doing good, they will add some money, either, but they can only add maximum this much. So when you go to job for a job and you think that your skills are so valuable that when you negotiate, you'll say, will you maximize your contribution to my retirement? Then they will say, yes, yes, we'll match. So then they will add 19,000 themselves to your 19,000. So you are getting 40,000 in the retirement every year. While most of the places will say, yeah, we'll match something, we'll put in $1,000, so we'll put in $2,000. Now, some employers, of course, are very, can we say, chalu. They will have vesting period. They'll say, fine, we'll add money, but only, and you will get that money only if you stay with us for 3 years or 5 years. If you change job before that, the part which we added, the employer added, is gone. The one which you add is transferable. But one will so money is typically withdrawn. Now this presentation you will get after I'm done, so you can read in details what is written here. Sometimes companies try to give you stock so that you work hard, so the company actually makes money. Because if the company goes under, it means nothing. Now here's another key: if you withdraw before your 15 and a half, then you get 10% penalty. Now I don't know why they came up with this weird number, but that was. But at the age of 70 and a half, they force you to take money out. Next. Okay. Now these are, I'm going to go quickly with this. These are other plans which say if you have a business, you have an ice cream shop, of course, just making up stuff, then you can actually put in, because you wonder, isn't it? What about a guy who does business? How does he transfer his retirement? And of course, you save money on the side on your investment accounts, but they also have retirement accounts like this. There's the SEP, then there is something called a simple, then there is all these different kind of plans for the people who are self-employed. Now this TSP is for people who work for the federal government as well as state government. Now my son is in military, so he gets a TSP. It's called Tithe Sharing Product or something. So it's very similar to 401k. But these are all different avenues are where you get to put pre-tax money. And as I explained, that is one of the better ways of saving money. Now, okay. Now that was 401k. So here's another way of saving money. It's called an IRA. So IRA is everybody can individually open their own IRAs. It doesn't have to be through the employer. But how much you can put in then is based on your income level. So if you make more than, I think it is 190 or $200,000, you cannot put in this. And same thing here, always try to put tax deferred. And same thing. So main thing is to put it tax deferred. And the second part is you can, when you withdraw, you are taxed at your income rate at that time. So when you are 70 and a half, most of us will not have salaries. Now this is typically held by the first thing, the 401k plan is held by your employer. and they decide where they're going to invest. Usually, it's a very conservative thing because they want to make sure that you actually have money when you retire. So those are more conservative mutual funds or other instruments. Now, these ones are held by the brokerage company like TD Ameritrade or others, and you have a say where you want to invest that. So you can be risky. You can put it in like companies which are going to you think are going to suddenly become very big, or you can put in like boring companies like oil, construction, this that, General Electric. Now this is a very nice article. Um, you can on your own time go through it. Now this is Roth IRA. So first one was traditional IRA. Now Roth IRA is when you put in money post tax. So contribution is after tax. Now, why this is important? You will say, why should I put post tax? Is because, first of all, number one, you are too rich to put in the traditional IRA. You make more than $200,000. Number two, you are rich that when you're going to give money to your kids, you don't want them to pay tax. So you say that well, you're like 40, you're making lots of money, and you're like three kids. So well, I will give X, Y, and Z amount of money to my son A, daughter B, and daughters of C. Now you don't want them to pay tax on that, so you already pay tax yourself, and all the withdrawals are tax free. Not just that, you can actually pull out money before age of 60. Remember, for the other one, we had to wait till 59 and a half. Here, you can't remove the earnings, but you can remove the contributions. And there are some income limits, but these are more than you can put money when you are richer than when you are in traditional IRA. And here, uh, and then this Roth 401k is very important when you become very affluent because it does not have income limits. So even if you are very well off, you can still put in money there. Now, at this stage, you must be thinking, oh, I'm barely getting money to eat. But I'm telling you, in 10 years, things will be very different. So time goes very fast. About 15 years ago, most of the investment advisor people did not want even to talk to me because I was not making enough money for them to waste their time on me. And things go very fast. So, what are the different types of assets? We have stocks, we have bonds, we have mutual funds, we have ETFs, and we have options. And we'll talk about each one of them briefly. Okay. So, stocks. So, most of you guys know what stocks are, kind of. Stocks is actually, you actually own a part of the company. Well, if you take the stock certificate and you go to the company's actual gate, nobody's going to take you in. But still, you are part owner of the company. And the stocks, how they make money is either the profit of the company is shared with you, which is called a dividend, or the company is doing good and everybody else wants to own that stock too. So the price of the stock goes up, which is called a capital appreciation. Most of the money is made by capital appreciation. But some is made by dividend. But this is also important, depend as you become more and more affluent, is that companies which pay dividend are usually stable companies. There will be companies like Pfizer, which make drugs and they're around for a long time. They make profit every year. And they don't make spectacular profit, like their share won't become look like from $10 to $200. No, but sometimes you want stability. And there are some people who only invest in companies which pay dividends because they don't have to worry too much. Like, okay, coronavirus came, small companies are going under. The companies which make food material, companies which make fuel, company which make, well, fuel right now is the exception, which make a washing machine, company which makes a cleaning powder for your wash basin or for your toilet. They, most of the big companies, Procter and Gamble is not going to go under. Okay, most Then there are two types of stocks, common and preferred. Usually, all of us common people buy common stock, and preferred stock are usually for people who were there when the company is formed, and they put in money, like the uncle of founder of the company, the uncle's neighbor, or somebody who put in. So they say, okay, uh, Mahesh, you're starting this company. Okay, I'll give you $100,000. I said, uncle, good, thank you. When my stock, you have preferred stock. So which means that if the company becomes good, you get higher dividend. But problem is that there are some special rules for preferred stocks. And preferred stocks, they are they can be as long as the company owner wants them to be. And sometimes they say, okay, enough of that. We'll give you the money you put in back with extra profit, and now onwards you don't have any preferred stock. Because there are some rules, like in some companies, the preferred stock people can have a special say on who will be on the board of directors, and they can meddle in the way the company is run. So if I was a founder, I don't want people to come and meddle uh, how I run the company. So those are nitty gritty stuff. But and of course, stocks, are different types. There is U.S. stocks, most of them. Then you have, Japan, and then you have BRIC. BRIC is Brazil. What is R? I forgot R. But Russia, India, and China. BRIC countries. And of course, you have large cap, which are huge companies. Like Caterpillar, GE, um, Ford. I don't know Ford or not anymore. But and then mid cap and then small caps. Basically, cap is capitalization. How much is the stock in the market, total stock worth? Now, two types of stocks, growth and value. Value are stocks of companies which are frankly boring companies. But boring is good because boring doesn't change much. And for most of the people, boring companies are good because they were there 50 years ago. They will be there 50 years afterwards. What is that? Hmm. There was some red mark on my screen, but anyway. And then there are growth companies are companies which you expect are um, are going to increase like crazy, like Peloton. They started this bicycle or walking machine. You think people are going to, or younger people now are going to get older. They are very health conscious. All of them are going to get Peloton bicycles. They're going to get new Peloton machine, which is going to give you electric shock if you don't get up in the morning, something like that. So growth companies are previous, like initially Google, Amazon stuff were growth companies. Now they are becoming value companies. And then there are different sectors: technology, industry, finance. Okay, and of course the stocks are exchanged on stock exchanges, which is Nasdaq and New York Stock Exchange. But nowadays, some people are there on the floor. Most of it happens by computers, and there's the OTC counter, which you don't have to know. Mm, Okay, and when you buy stocks, once you get into it, you'll realize that there are different characteristics of a stock. How much is a how much is the earning yield? How much is a price by earning? Like some companies have a big price, but they are earning nothing. Most of the startups and um, companies which are high tech companies, they don't earn initially. Like there was a place called a company called Workspace or Workplace. They just kept on buying stuff, hoping to rent it out. But their stock was very high at one time because everybody thought they were going to make lots of money. And now I think they fired their CEO. So there are different things. If you're interested, you can go on Investopedia and there's information about that. Now here's something of practical importance. Now you guys buy stocks through a broker. It can be a human broker or it can be on a computer. Most of us are going to buy through a computer. And so when you want to buy a stock, it's two ways of ordering. One is called a market order, and other is called a limit order. So in market order, what happens is that you essentially tell the system that I want to buy. And so there are two prices for everything. There is a bid price and an ask price. So when you want to buy, you pay the ask price, which is slightly larger than the bid price. And when you want to sell, you get the bid price. And the company which owns the software on which you do the trading pockets the difference. Like IBM, bid price is 102.4, ask is 102.42, so there are 2 cents. And so you want to sell, you can only sell it for this money, and you want to buy, you get money. So 2 cents are eaten up by the um, company which is having the platform for trading. So you say 2 cents, that's so little. But 2 cents into 100 is $2. Now there are millions of stocks being sold and bought. They make lots of money. Till recently, they were also charging you commission for doing a transaction, $10, $15, $7. So those rascals were actually making money like this and plus shamelessly asking us for commission too. But anyway, we needed them. So right now, most of the platforms don't have any commission. So if somebody is asking you commission to do a trading, uh, say no to them. Now, okay, like if you have $100 or $10, how do I buy my first stock? So now there are many online computer systems. They're called robo advisors. There is no human being there, where you enter what you want and they'll give you advice. If you There's a nice article on Investopedia, and they tell you, there's a whole list of robo advisors. Robo advisors are essentially, you say, and it gets more elaborate. You can put your current age, your income, how much you want to put per month, and when you want the money out. They'll do projections, this and that. It gets very sophisticated, and it's fun actually. I think one day when you get tired of studying, just go and play with it, and open an account. Open an account with some of them lets you open an account for $5, but I would open it like for 10, $20, and some of them give, like Robinhood may give you like one share of one company to make you feel good that "Oh, wow, I got one share." So you buy shares, play with it, um, play with $5, play with $100, but because soon you'll be playing with thousands and thousands of your hard-earned money. So then you buy, and well, this is not actually that important, but so for dividend, so when you buy is important if you're going to buy millions of dollars of stock, because then who gets the dividend it depends on that. But if you're going to buy like few hundreds or thousands, it doesn't really make a difference when you are actually buying it in terms of who gets the dividend. And there is something called a stock split. This is just terminology. It's not for practical use at this time. Stock split means if you go directly to the example below, like say Mike owns 100 shares of Oracle at 30, and Oracle does a split. So suddenly he will own 150 shares, but the price of the each share is low. It has decreased. So the worth of the shares is same. Even though it's split, it is same. Sometimes the shares are joined together. The split is done because if, say, Mandar Associates company, my company, when the share is now $3,000 because I make so much profit, so much profit. But for $3,000 per share, who can afford to buy it? Not most of the people. So what I will do, I will split into $1,500. So fewer more people can buy it. So it will be traded more. So more trading is done, the chance of my price being in good shape is better. Okay, so shares are done. Now we have bonds. So bond is what? Bond is a loan. So the loan either you give it to a company or you give it to the government. And the company means any company can ask. Many banks have bonds. Many pharmaceutical companies have bonds. Or when you say government, the government is either the federal government, or it could be the state government, or it could be the municipality of your local city government. And those people, they government takes loans for specific projects. Sometimes they take um, loans. Okay, for we need to have a new water filtration system, so there will be a bond, a Peoria, Illinois water filtration bond, something like that. Advantage of bond is that they come in as is taxable and non-taxable thing. US government bonds don't have state tax, but you may, depends, have to have federal tax. Municipal bonds are usually free from both state and federal tax for people who live there. The advantage is that municipal parties, unless it's like Detroit, which went bankrupt, usually don't go bankrupt. Safest is US government. They will always pay money. Now, as you know, whatever is safe is not very profitable. But sometimes when you want to have some of your money in a very safe place. So if everything goes to hell, like it is going now, or it is starting to go now, it's good to have something which is still going to be there. Now, there is something when you buy a bond, it's very interesting. Bond has a par value, which is a value written on the face of the bond. And you actually buy, like if it's $1,000 bond, you buy it for 950. And when the bond matures, you give it back to the bond issuer and they will give you $1,000. So you get it as a discount. So it's a somewhat of unusual system, but that's how it works. And taxable ones are mostly corporate bonds. Usually different companies, they want loan to do something. Then all these companies have a rating. This S&P and Moody, they give a rating. A, double A, triple A, double B, B plus plus, and then junk bond. Junk bonds are companies which don't have good rating. But because they are risky, they give good amount of money for you to take the risk. And then US government gives bonds in three flavors. It's called T-bills, treasury notes, and treasury bonds. And you can just Google it and figure out exactly what they are. Now they are depending on the length of the things. These are the safest. Like say tomorrow, your son gets married and he has a baby, and you want to give something to a baby. Give them a treasury bond. Like say, okay, my little grandson, granddaughter, here's $100 bond. So that by the time they are 25 and go to college and you are no more, or maybe you are, they have a legacy left by somebody. So people actually, I give an extreme example, but people, when you diversify, as I said, remember the first slide, diversify, diversify. So some people put some money in treasuries. So you put money in stocks, you put money in bonds, you put money in treasuries. Then there are other people who give things like, Freddie Mac, Freddie Mac. These Freddie Mac, Freddie Mac are the people who give loan for you to buy apartment complexes or businesses and stuff like that. We talk about municipal bonds, corporate bonds, and this is something I don't know what exactly it is, but there are also other types of people who want your money. Now, what's the risk of bonds? The bond, of course, the risk of stock is very obvious. You buy a stock today for $10, and tomorrow something happens and it goes to $8. You lost money. With bonds, um, now if you buy a bond which says will give you 4% interest, good, 4% interest. But unfortunately, tomorrow in America, if the inflation increases, that 4% actually the value of the 4% decreases because of the inflation. Like today, the inflation is approximately 2.35. That means in about 26 years, you need double the money to buy the same thing. So if you get a milk today for $2, in 26 years, you need $4 to buy the same milk. Well, this is assuming that everything else about milk production, milk delivery, and a fad of drinking milk remains stable, but just financially speaking. And there are other things. Credit risk is, the borrower is given like BBB risk, but suddenly I don't know something happens and the company goes down. So these are all different types of risks. Now mutual fund. What is mutual fund? I think I'll go faster. So mutual fund is that okay? So if somebody wants to buy shares, so he buy few shares of this company, few shares of that company. But since you don't have lots and lots of money, you'll only buy like 5 shares of this company, 10 shares of this company, 100 shares of this company. And so you can only buy shares of say 2, 3, or 5 companies. That's risky because lesser the companies, higher the chance of some of them going belly up. So then you have something called mutual fund. In a mutual fund buys shares of lots of different companies based on what the mutual fund is. And so if there is a large cap mutual fund, as you say, large cap are big companies. So large, say, again, I'm just saying, okay, Uh, Michael Jackson, just name of the company. Okay, Michael Jackson Large Cap Mutual Fund. So Michael Jackson Large Cap Mutual Fund will actually have shares of 100 large companies. And then when you buy one share of Michael Jackson Mutual Fund, you buy a tiny fraction of shares of all those 100 companies. So your risk is less because you now own a tiny fraction of all those companies. So even if 10 of those go belly up, you still are okay. Now, the people who make these mutual funds are not people, they are big companies. And those companies, then they charge a fee for keep doing all this work for you. And then there is something else. So this is very important. Whenever you buy a mutual fund, you have to see how much is the management fee. Is it try for a management fee which is the lowest possible? Because over the years, this eats into your profit. Now there is something called load and no load. Load means they say, okay, my mutual fund is great. If you want to get on this wagon, you need to pay X amount to get in, or when you get out. Now those are nowadays it's out of fashion. Not nobody buys load fund. Nobody is willing to give money to get on that thing. Now there are other costs like trading cost and then there's marketing cost, which are so basically mutual fund is good because your risk is spread across lots of companies. Now, there are disadvantages of mutual funds is that mutual funds price is only decided once a day. So somebody came up with something else. It's basically I'll show you about it. So here the mutual fund, has covers a large variety of assets, and there are passive or active. Active is one guy is at the helm of the mutual fund, and then he buys and sells, and he thinks, this company is go high, let me buy. This company is going to go down. So he sells and buys, and he himself gets lots of salary. Then there are passive funds, which are called index funds. They are linked to different indices, like an S&P 500, this and that. So those are basically linked to some index. Index is a kind of a landmark. So there is not much trading. So they have less amount of fee. So best thing is to when you start, you should just uh, go into index funds. Then something called ETF. Now, ETF is um, these things are just like mutual funds, but they work like shares. So the price goes up and down every minute or whenever trade happens, and they are traded as shares. So they are mutual funds which are traded like shares, and many of them are passive. So they have lower fees. They don't have some big boss sitting in an office actually controlling them. So ETFs are easier. So if I was you, I would start buying some ETFs and then maybe few shares and get to know how this thing works. Then there is options, and options are kind of risky stuff. I would not. I just put it there because just to know that it is there. And some of you who have more strong thought process may read about this. Basically, you are guessing whether something is going to go up and down and buy it or sell it for a future date. I myself have never done this. And usually this is done by people who have lots of time to put in this. But it is just a way. If somebody wants, they can go and investigate that. But this is beyond my skill set. And it is a put call. Okay. So we talked about different asset class. We talked about shares. We talked about bonds. We talked about mutual funds. We talked about ETFs. And we talked. And then there are alternate things, which you will think about when you have more money. Where of course you buy either you can buy real estate. You can actually buy real estate and manage it yourself, or buy real estate or give it to a management company, or you actually don't buy real estate, you buy shares of a company which buys real estate, or there are other companies which give money to real estate people who buy real estate, and you actually loan money to those guys, or you buy a fraction of, like somebody is buying a $10 million apartment complex, and then they will sell shares of that apartment complex to people. And so you own not 10%, like 2% of that apartment complex. You actually never know where the apartment complex is, but every month you get X amount of money as part of the profit. Then there is commodities, which is actually grains and pig bellies and bacon and meat and all these things. And there is forex, and then there is private equity, where essentially rich people come together to support somebody's endeavor. Like say, tomorrow one of you starts a company and you want money to make it big. So you come to some rich people and say that, well, I want $10 million. And you see that Shark Tank thing. It's essentially Shark Tank. Then there are hedge funds. Hedge funds are people where somebody knows that somebody thinks that he will make lots of money on stock market because he knows how to predict which stocks are going up and down. And then some people trust him and they give him money. And whenever he makes money, he takes extra. He has his own fee, plus he will take a percentage of the profit he makes for you. If he loses money, he doesn't get the percentage of loss. But hedge funds, stay away from them unless you are in at least 10 to $15 million net worth. Then think about doing that. Unless you have your hedge fund, then you can make money from that. Now, I'm going to quickly wind up, but taxes. This is very important because you will be paying taxes. Unless you have your own business, then you can do some dance around paying taxes. But two things which are important: short term and long term. Short term is when I buy shares today morning, and tomorrow morning market goes up, I sell, make money, I'm very happy. This is taxed at the same level as your regular income. That means the income tax you pay for your salary, which is pretty high. Well, then there is long-term gains. So you buy Amazon shares today and you sell them after more than a year. Usually it's a year, or you sell them after 2 years. Then the profit you make is capital gains tax, which is 20% max, at least now. So this is, if you're at you guys are, most of you guys who have are undergrads, masters, PhD, you guys are going to earn more than $100,000 at one time in your life. You will be paying a good amount of tax. But if you could get tax at this level, you are happy. So aim is to put everything in your capital gains tax. So and then there is some more complications that which your tax accountant will deal with that. That's so remember, tax is important. So when you make money, be happy, but think about tax. Now, so then based on tax, some people say that okay, try to put some like your taxable bonds and REITs in one way or something in other. This is too much nitty gritty. Okay. Other thing, this is the slide you have to think about. Okay. Here's the example: minimizing the cost. Remember, I told you about the fee. So if you buy $100,000 of mutual fund instead of an ETF and pay extra 1% management fee, at the end of 30 years, and if you earn 8% every year on both these different things, with an ETF, you'll be making 1 million, and with the mutual fund, you are making 750. Because this 1% keeps on adding and adding and adding and adding every year. That's why ETF is so popular nowadays, because the fees are very less. Okay. Other thing, so we talked about taxes, we talked about fees and inflation. As I said before, in India, inflation used to be very high. When people came here first, they said, what, in America you get 1% interest. In India, we get 18% interest. But then I didn't realize that India, the inflation is so high that after 1 year, that $1 is not worth $1 at all. It's worth 80 cents or 60 cents. In America, there is inflation, about 2.7%. So as I said before, for every 26 years, you need twice the money to buy the same spending power. This is the same spending power you have to have. So inflation is the biggest enemy of the conservative investor. That means if you say, I don't want to put money in shares, I don't want to put in mutual funds, I will do the safe thing. I will put it in a saving account or in checking account or in money market account. It will remain safe, but it will not be worth that much money when you retire. The amount of money, amount of stuff you can buy by the same amount of money is going to be very less. That's why you have to invest in these kind of things. Remember, more the risk, more the reward, usually. Finally, okay, let me get out of that. Mm, click to. Mm. I'm trying to figure out how you can see my face again. Oh, stop share. Okay. So, as you can see, this was a pretty um, superficial talk. I was just giving you a flavor of different things which are available. And you guys are smart. You guys can go on online and go into details. But the message which I want you to take from today's talk is number one, start today. You can start even with $5 and think as an investor. That means that if there is something to be bought, believe me, I'm not asking you to live in complete uh, misery and not spend money for your happiness right now, but save money, save often, and save intelligently. And I'm telling you, after 20, 30 years, you will be very happy when you look at your um, investments. Thank you. Um, do we have any questions? Is everybody muted? Is anybody there on the talk, or I'm just talking to myself?
Namaste,
Yeah,
sir.
hi.
I have one question. Oh,
Okay,
sorry.
go ahead.
Hi.
You can go ahead.
Yeah, so I have one question.
Mhm.
So, did you tell about taxes on short-term investment and long-term investment? So, can you give us more detail on it?
So basically, short-term investments are taxed as regular income. Now, this is very important when you become high net worth. Like, so people who make, I'm, I'm not exactly sure the number, but say just for like okay, say you make $250,000 per year. So you are at almost 42, like, with the federal, state, Medicare, blah, 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 you are losing almost 45 to 48% to tax. That time, if you sell a short-term investment, whatever you make, you are losing 40% of that to Uncle Sam. And for long term, if it is the capital gains, it is between 0 to 20%, about 15%. So that much extra profit you get. Now, if you are making lots and lots of money with your short-term investments and you are not paying that much tax at particular level, then fine. But if I'm talking for normal, ordinary people, you guys are going to be at a higher tax bracket. For then, the money you make with short-term investment, lots of it is going to go to taxes, about at least 35 or more percent. That's it. Who
Thank
else
you.
had something? And who else had something?
I had a question about short-term investments like day trading and whatnot.
Yes.
Um, so do you have so like obviously it's important to invest for the future and for retirement and whatnot.
Yeah.
But do you have specific advice for individuals who also want to play the market day by day or in a period of a few months and whatnot?
See, I'll frankly tell you, I'm a doctor by profession. So and I subscribe to some services where people advise me, oh, buy this today and sell it tomorrow, and I have done that. But a couple of things is it is risky. So if I was doing day trading, I would not. I would do it with a fixed amount of money. If say um, now you are a student, so I'm just giving you an example. Okay, if somebody is saying, okay, it's like day trading. Sometimes nobody looks at it as gambling, but technically it's gambling with a knowledge. So you have to put a limit on that. You take X amount of money. You said, I'm going to use this $10,000 and make money on this. And you say that, I'm okay to lose all the money, because what happens is that when people do day trading, they don't use, they don't buy shares of $10,000. They use that money to leverage and buy shares of $100,000 or more by buying options and stuff. So you better know what you're doing, because it's very risky. By buying options is, mm, I didn't talk about options. It means that, okay, today Amazon is for 1870. I'm buying an option that in 1 month it will be 1950, or I'm buying an option that it is going to be 1700. So if it goes to that level, I make lots of money. But if it doesn't, I lose everything. Now, if you're going to do day trading, I would actually seriously maybe take a course or study in details, and do it only with a fixed amount of money, because um, first few times you might be lucky and get money, and if you're not lucky in next few times, you say, no, I will be lucky again, and you can start. It's a slippery slope. And I have friends actually who not only did day trading, but they also used to attend all the conference calls of small pharmaceutical companies to know which drugs are coming and which phase is a drug and this and that, and then try to bet based on that. And well, some of them actually are in the real financial. But I'm not discouraging you, but um, I would do it with a fixed amount of money and stick to that money. And
Okay. Thank you, sir.
it looks like everybody is happy. No more
I have
questions.
one quick question. So, like, some of us plan to return back to India at some point in time,
Mhm.
and let's say we have investments over here. So,
Mhm.
how does that work? Like, can we leave them over here while being in India, or?
Yeah, I don't know details of that. You might have to ask actual professional, but I don't think there should be a problem. Like most of America is owned by the Arabs and Chinese, so like frankly, lots of most of the stocks in this country, America is very stable. So all the people all around the world with lots of money, they invest here. So if you buy stuff here, and and now with internet you can do trading or anything anywhere. So sure, why not? You can keep it here. I don't think there's a problem, but before you actually leave, you might actually ask somebody who does this for a living before you do that. But I don't think there's an issue.
Thank you.
So on the follow-up of that, uh, so so will there be any significant difference between how the invest how we should invest if there is this kind of if we eventually go back to India and we want to pack up everything here,
Yeah, no. So um,
or like it's still considered long-term
yeah, long term,
strategy?
even no, no, it's fine, because worst case scenario, you might have to sell everything, and
Mm.
hopefully it is not market like today or like yesterday, and that you are selling at a high thing. But if you don't want to have, if you want to pack up everything here, and last 1 year of your life here, I would watch the market carefully, and if there is a slight thing about something happening, I would just sell off everything and keep it cash. Cash is king. It's better to have money as cash and not get some extra profit than market go down. Like right now, most of my friends have 20% money has evaporated in last 3 4 weeks. So market goes down before uh, you know. So if you wanted to pack everything and go back and have nothing to do with this country, I would last 1 year at least. I would watch the market and slowly, don't sell everything in 1 day, but do like a allotment. 20% in January, 20% in February, 20% in March, so that market goes up and down. You're not losing everything. Be conservative. It's better to be conservative than. Uh, and I always say, cash is king.
Okay, thanks.
So I have a quick question on that. Can I? Is that still time for a question or?
Yes, I'm not running the show actually. Somebody else.
Yeah, go ahead. Go ahead.
Okay. So as you just said, in the last 3-4 weeks, the market has been down because of the coronavirus thing. Do you think that this is the right time to invest actually?
Yes, actually, this is the right time to invest. But here, let me qualify this. We don't know if the market is going to go down below, because right now it's like 2-3 weeks. Okay.
Yes.
And Trump just signed something saying that they're going to put $1 trillion into the market.
Yes.
So the market, like on Wednesday went up a lot. Thursday it went up a lot, and Friday again it went down.
Okay.
So yes, if you have a little money and you want to forget about the money for few months or maybe a year or two, yeah, find a good company and buy it, and then stop checking on it every day. Otherwise, your blood pressure is going to go up.
Okay. So just to be clear, so if we plan to invest, basically choose a low point in the coming weeks, invest, and then basically leave it for a year or two when the market stabilizes back.
Yeah.
And then
or if you have an iron strength, you can sell buy, and because you are right now at your tax, essentially you don't get tax, you don't have that much tax, so make some money. But I'm telling you, go play with the money you can afford to lose.
Okay.
Don't play with the money which you're going to buy your ticket to visit your house in next summer. Going back to India.
Okay.
Okay.
Thank you.
Yeah. And over time, one thing I forgot to tell you, that over time from 1929, when the Great Depression happened, and since when the data we have, market has always gone up over time. It takes about whatever has happened, there have been lots of things happening. It took sometimes it takes 5 years, but overall the graph goes up. It goes like, this is my mouse, it goes with this slope. But what happened recently, it went up like this, and now it is like this. So over time, if you have long term, like if there's a good company, that's why ETF is good, because there are multiple companies. There are companies which usually you don't think will go bankrupt. Those, if you invest now, and then you're 46, and they say, I had invested this much, let's see what happened. And I'm sure you have made lots of money on that. But but there are some companies which have disappeared, which you don't think would, like I'll just say for fun, I'll tell you, big companies in America like Pan Am, TWA, Eastern Airlines, nobody knows these companies anymore. At one time, they were the bulwark of the American economy. Nobody knows Pan Am. Actually, when I was little, I had come to America with my parents, and we had stayed in a hotel which was owned by Pan Am, and everything was Pan Am, Pan Am, Pan Am. When I came this time means about 25 years ago, nobody knew what Pan Am was. So, but yeah, that's why ETFs and stuff are safer, because there are 50 companies in that. All of them are not going to go bankrupt.
Yeah.
Okay, looks like it's 8:05. There are other programs starting now. Namaste, everybody. Hope this was useful. And remember, I'm not a finance professional. I'm just amateur like you guys, just older, and has been here for at least 25 years in this country. And that's all. Namaste, Shubharatri.
Namaste, Mandarji.
Namaste, Shubhratri.
Namaste.
Namaste, Shubhratri.